Let me tell you something that's going to shock most investors. I don't care about stock prices. I really don't. You can tell me your tech stock went up 50% last month, and I'll tell you the same thing I tell entrepreneurs on Shark Tank. Show me the cash flow, because at the end of the day, if a company isn't putting money in your pocket, you don't own an investment. You own a lottery ticket. And I don't do lottery tickets. I'm Kevin O'Leary. I've built multiple companies worth hundreds of millions of dollars. I've invested in over 100 businesses. I manage billions in assets. And I'm going to tell you exactly why dividend stocks are the only investments that matter for serious wealth building. Not speculation, not hoping some greater fool will pay you more tomorrow. Real investing, the kind that generates cash flow you can spend, reinvest, or retire on. Here's what nobody wants to admit. 71% of total stock market returns come from dividends, not price appreciation. Let me say that again because it's critical. 71%. That means if you're chasing stock prices and ignoring dividends, you're missing the majority of what makes stocks valuable. You're playing the wrong game. And the market will eventually punish you for it. I didn't always understand this. When I was younger, I thought I was smart enough to pick winners, buy low, sell high, time the market, beat the professionals. You know what I learned? I wasn't that smart. Nobody is. The people who claim they can consistently time the market are either lying or haven't been doing it long enough to get humbled. The market has a way of destroying arrogance. So I changed my strategy completely. Instead of trying to predict which stocks would go up, I started asking a different question. Which companies are generating so much cash that they can afford to pay me every quarter, regardless of what the stock price does? That question changed everything. It transformed me from a speculator into an investor. And it's made me wealthier than I ever would have been trying to outsmart the market. Let me explain the fundamental difference between investing and speculating. When you buy a stock that doesn't pay dividends, your only hope of making money is selling it to someone else for more than you paid. That's speculation. You're betting on price movement. You're betting on sentiment. You're betting on what other people will think the stock is worth in the future. There's nothing wrong with that if you understand what you're doing. But don't confuse it with investing. Investing is buying a piece of a business that generates cash flow and returns that cash to you as the owner. Think about it this way. If I offered to sell you a private business, what's the first question you'd ask? You'd ask how much money it makes, how much cash flow it generates, what return you'd get on your investment. You wouldn't buy a business that loses money year after year just because you think maybe someday someone else will pay you more for it. That would be insane. But that's exactly what people do in the stock market. They buy companies with no earnings, no cash flow, no dividends, and no plan to ever generate returns for shareholders. They're buying on hope, on narrative, on the belief that someone else will be willing to pay more tomorrow. And sometimes that works. Sometimes you get lucky. But it's not a strategy. It's gambling. Warren Buffett, who I respect tremendously, likes to say that a stock is just a small piece of a business. He's absolutely right. When you buy a share of stock, you're buying a fractional ownership in a company. You're a business owner, and business owners should expect their businesses to generate returns. If your business isn't generating cash that flows back to you, what exactly do you own? This is why I'm obsessed with dividends. A dividend is the only mechanism through which a shareholder can receive a return without selling their position. It's the company saying, we made money, we don't need all of it to grow the business, so here's your cut as an owner. That's what ownership should mean. Participation in the profits. Now, some people argue that companies shouldn't pay dividends. They should reinvest everything back into growth. And for certain companies at certain stages, that makes sense. Amazon didn't pay dividends for decades because Jeff Bezos was building an empire. Every dollar went back into expansion. Fair enough. But at some point, mature companies generate more cash than they can productively reinvest. At that point, hoarding cash is just management being greedy or incompetent. Return it to shareholders. Let me give you the math on why dividends matter so much. Since 1957, the price return of the S&P 500 is over 6,500%. Sounds impressive, right? but the total return, which includes dividends reinvested, is over 46,000%. Think about that gap. If you just owned the stocks and collected the price appreciation, you got 6,500%. If you reinvested the dividends, you got 46,000%. That's 7 times more wealth. 71% of your returns came from dividends and the compounding effect of reinvesting them. This is the power of compound interest. Einstein allegedly called compound interest the most powerful force in the universe. I don't know if he actually said that, but it's true either way. When you reinvest dividends, you're buying more shares. Those shares generate more dividends. You reinvest those dividends to buy even more shares. It's a snowball effect that builds exponential wealth over decades. Let me walk you through a real example. Let's say you invested $10,000 in the S&P 500 inches 1957. If you just held the stocks and never reinvested dividends, that $10,000 would have grown to about $650,000 by 2020. Not bad. That's a 6,500% return. But if you reinvested every dividend, that same $10,000 would have grown to $4.6 million. Same stocks, same time period. The only difference is reinvesting dividends. That's an extra $4 million in wealth. Now, most people don't have 50 or 60 years to compound, but the principle applies regardless of your timeline. The earlier you start reinvesting dividends, the more powerful the compounding effect. Even if you're starting later in life, reinvesting dividends for 20 or 30 years, it still produces dramatically better results than ignoring them. Here's another critical advantage of dividend stocks. They provide stability and income regardless of market conditions. When the market crashes, and it will crash periodically, your dividend-paying stocks keep sending you checks. The stock price might be down 30%, but if the company is still profitable and maintains its dividend, you're still getting paid. You don't have to sell at a loss to generate cash. You just keep collecting your dividends and wait for the market to recover. Contrast that with owning stocks that don't pay dividends. When the market crashes, those stocks fall just like everything else, but you have no income stream. If you need cash, you're forced to sell at depressed prices. You're locking in losses, and when the market recovers, you're sitting on the sidelines with less capital. It's a disaster. I saw this play out during the 2008 financial crisis. The market got destroyed. Stock prices fell 50% or more. People panicked. They sold everything. They went to cash. But the dividend investors, the ones who owned quality companies with strong cash flows, they kept collecting their dividends. Most of those companies maintained or only slightly reduced their dividends. The income kept flowing. And when the market recovered, dividend investors came out ahead because they never had to sell. The same thing happened during the 2020 pandemic crash. The market dropped 30% in a month. Panic everywhere. But quality dividend stocks mostly maintained their payouts. Johnson & Johnson, Procter & Gamble, Coca-Cola, all kept paying. Some even raised their dividends during the crisis. If you were living off dividend income, you barely noticed the crash. Your cash flow continued uninterrupted. This is why I designed my own ETF, OUSA, focused entirely on high-quality dividend-paying companies. I wanted a fund that embodied everything I believe about investing: quality over growth, cash flow over speculation, stability over volatility. OUSA holds about 100 companies, all large cap, all profitable, all paying dividends. These are the blue chip businesses that form the backbone of the American economy. Let me walk you through what's in OUSA. The top holdings include Microsoft, Johnson & Johnson, Home Depot, Procter & Gamble, Merck, Verizon, Pfizer, Apple, Cisco, Honeywell, United Health Group, Amgen, Coca-Cola, Lockheed Martin, Pepsi, and 3M. These aren't speculative startups. These are companies that have been around for decades, in some cases over a century. They've survived multiple recessions, wars, market crashes, and pandemics. And they've kept paying dividends through all of it. The sector diversification is intentional. 22% in healthcare, 21% in information technology, 16.5% in consumer staples, almost 15% in industrials, the rest spread across other sectors. This diversification protects you from sector-specific shocks. If technology struggles, healthcare might thrive. If consumer staples lag, industrials might lead. You're never completely exposed to one area of the economy. OUSA pays monthly dividends to shareholders. The amount varies based on what the underlying companies paid that month, but it's consistent income. The annual yield tends to be around 2%, which is higher than the S&P 500 but lower than some high-yield dividend funds. That's intentional. I'm not chasing yield, I'm chasing quality. High yields are often a red flag. They indicate the market thinks the dividend is unsustainable. I'd rather have a lower yield from a rock-solid company than a high yield from a business on the verge of cutting. Now, let's talk about dividend growth, because this is where things get really interesting. The best dividend stocks don't just pay dividends, they raise them year after year. From 2010 to 2019, the dividends per share paid by companies in the S&P 500 more than doubled. That's a growth rate of about 11% annually. Think about what that means for your income stream. If you retire with a portfolio generating $50,000 a year in dividends, and those dividends grow at 11% annually, in 7 years your income doubles to $100,000. In 14 years it's $200,000. You're getting raises in retirement without doing anything. The companies are growing, they're generating more cash, and they're sharing it with you as an owner. That's the power of dividend growth. This is why I focus on dividend aristocrats. These are companies that have raised their dividends for at least 25 consecutive years. 25 years. Think about what that means. These companies raised dividends through the dot-com crash, through 9/11, through the financial crisis, through the pandemic. They have business models so durable and cash flows so strong that they can commit to returning more money to shareholders every single year regardless of economic conditions. Johnson & Johnson has raised its dividend for over 60 consecutive years. Procter & Gamble, over 65 years. Coca-Cola, over 60 years. These companies have been paying and raising dividends longer than most investors have been alive. That's the kind of reliability you want in a portfolio, not some hot tech stock that might be gone in 5 years. Let me address a common criticism of dividend investing. Some people say that dividends are tax inefficient. They argue that you pay taxes on dividends every year, whereas if you just held growth stocks, you could defer taxes until you sell. And they're right that qualified dividends are taxed, but they're taxed at preferential long-term capital gains rates, which for most people is 15%. Some retirees pay zero on qualified dividends if their income is low enough. Compare that to pulling money out of a traditional IRA or 401k, where you pay ordinary income tax rates that can be 25, 30, or even 37%. Dividends in a taxable account are often more tax efficient than retirement account withdrawals. And if you hold dividend stocks in a Roth IRA, the dividends are completely tax-free forever. You can't beat that. Here's another advantage people overlook. Dividend-paying companies tend to be more disciplined with capital allocation. When management knows they have to pay a dividend every quarter, they can't waste cash on empire building, acquisitions, or vanity projects. They have to be efficient. They have to generate real profits. The dividend acts as a governor on management behavior. Contrast that with companies that pay no dividends. Management can hoard cash. They can burn money on failed experiments. They can overpay for acquisitions to boost their egos. And shareholders have no recourse. You're just along for the ride, hoping management makes good decisions. With dividend payers, you get a tangible return regardless of what management does with the rest of the cash. Now, I want to be clear about something. I'm not saying you should only own dividend stocks. I own some growth stocks. I have exposure to technology companies that don't pay dividends. I even launched another ETF called OGIG that focuses on global internet giants like Amazon, Alibaba, Facebook, Alphabet, and Shopify. These companies don't pay dividends. They're reinvesting everything into growth, and they've produced massive returns. So am I being hypocritical? No, I'm being diversified. The bulk of my wealth, the core of my portfolio, is in dividend-paying stocks. That's my foundation. That's what pays my bills and funds my lifestyle. But I also allocate a portion to growth for upside potential. The key is knowing the difference. The dividend stocks are investments. The growth stocks are speculation. I treat them differently. I size them differently. and I have different expectations for each. For most people, especially those over 50, the majority of your portfolio should be in dividend payers. You need income, you need stability, you need sleep at night investments. You don't need to swing for the fences trying to find the next Tesla. You need companies that will pay you reliably for the next 20 or 30 years while you're retired. Let me walk through how I actually construct a dividend portfolio. First, I look for companies with long histories of paying and raising dividends. I want at least 10 years of dividend growth, preferably 25 or more. That tells me the company has a durable business model and a commitment to shareholders. Second, I look at the payout ratio. That's the percentage of earnings the company pays out as dividends. If a company earns $5 per share and pays $2 in dividends, the payout ratio is 40%. I like payout ratios between 40 and 60%. That's sustainable. It means the company has plenty of cushion to maintain the dividend during tough times and room to raise it as earnings grow. If the payout ratio is over 80 or 90%, that's a red flag. The dividend is at risk. Third, I look at free cash flow. Dividends are paid in cash, not accounting earnings. So I want to see strong free cash flow generation. If a company is generating $1 billion in free cash flow and paying out $400 million in dividends, I'm comfortable. If they're generating $100 million and paying out $400 million, they're borrowing to pay the dividend. That's unsustainable. Fourth, I look at the balance sheet. Companies with too much debt are vulnerable during recessions. When revenue drops and they still have to service debt, the dividend is at risk. I want companies with manageable debt levels and strong interest coverage ratios. That means they can easily afford their debt payments out of operating income. Fifth, I look at competitive position. Does the company have a moat? Is there something structural that prevents competitors from taking market share? Brand loyalty, patents, network effects, high switching costs, economies of scale? If a company has a moat, its cash flows are more predictable and sustainable. If it's in a commodity business where anyone can compete, the cash flows are at risk. When I put all these criteria together, I end up with a list of maybe 30 to 50 companies that meet my standards. Then I diversify across 20 to 25 of them, spread across different sectors. That gives me exposure to the best dividend payers while managing concentration risk. Let me give you some specific examples of companies I love. Johnson & Johnson is the gold standard of dividend stocks. They've raised their dividend for over 60 years. They operate in healthcare, which is recession resistant. They have multiple blockbuster drugs and consumer products. Their brand is one of the strongest in the world, and they generate obscene amounts of free cash flow. If you own one dividend stock, J&J is a great choice. Procter & Gamble is another favorite. They own brands like Tide, Pampers, Gillette, Crest. These are products people buy regardless of the economy. When you're in a recession, you still need toothpaste. You still need diapers if you have kids. P&G has pricing power because their brands are trusted. They can raise prices to offset inflation, and they've been paying dividends since 1891. That's over 130 years of continuous dividends. Coca-Cola is the ultimate dividend machine. Warren Buffett has owned it for decades. It's one of the most recognized brands on the planet. They sell a product that costs pennies to make and sells for dollars. The margins are incredible, and they have distribution in nearly every country on earth. Coke has raised its dividend for over 60 consecutive years. The yield is around 3%, and it grows steadily. In the technology sector, Microsoft has become a dividend powerhouse. They started paying dividends in the early 2000s and have raised them consistently ever since. They generate massive free cash flow from Windows, Office, Azure Cloud Services, and gaming. The business is incredibly profitable, and while the yield is lower, around 1%, the dividend growth is strong. Microsoft is one of the few tech companies that combines growth with income. In telecommunications, I like Verizon and AT&T. These companies have to pay high dividends because their stock prices don't move much. They're mature businesses with limited growth, but they print cash. People need wireless service. People need internet. These are utility-like businesses with yields in the 5 to 7% range. Yes, they have debt. Yes, they face competition, but they're not going anywhere. In healthcare, besides J&J, I like companies like Merck, Pfizer, and Amgen. They have strong drug pipelines, patent protection, and recurring revenue. Healthcare is one of the most defensive sectors. People don't stop taking their medications during recessions. These companies have sustainable dividends with room for growth. In consumer staples, besides P&G and Coke, I like Pepsi, Colgate-Palmolive, and Kimberly-Clark. These are the companies that make products you buy at the grocery store every week. Toothpaste, soap, toilet paper, snacks, boring products, consistent demand, reliable cash flows. In industrials, I like companies like 3M, Honeywell, and Lockheed Martin. 3M makes everything from Post-it notes to medical equipment. They've been paying dividends for over a century. Honeywell is diversified across aerospace, building technologies, and materials. Lockheed is a defense contractor with long-term government contracts. All of them generate strong free cash flow and pay reliable dividends. Now let me address fees, because this is where most investors get quietly destroyed. OUSA has an expense ratio of 0.48%. That means you pay $48 a year for every $10,000 invested. Some people complain that's too high compared to index funds that charge 0.03 or 0.05%, and they have a point. Fees matter. Over decades, they compound against you, just like returns compound for you. But here's my counter-argument. OUSA isn't an index fund. It's an actively managed strategy focused on quality dividend payers. We screen for financial health, dividend sustainability, and growth potential. We rebalance based on changing conditions. We're not just buying the whole market, we're curating the best dividend stocks. That curation has value. Whether it's worth 0.48% is up to you to decide. For investors who want to minimize fees, you can absolutely build your own dividend portfolio with individual stocks. You'll pay a small commission to buy, maybe zero with some brokers now, and that's it. No ongoing fees. You own the stocks outright. If you're willing to do the research and monitoring, that's probably the most cost-effective approach. Or you can use low-cost dividend ETFs from Vanguard or Schwab that charge 0.06 or 0.1%. You'll get broad dividend exposure at minimal cost. The trade-off is less curation. You'll own some lower quality companies mixed in with the good ones, but for passive investors, that's a fine approach. The point is, don't let fees eat up your returns. Whether you pay 0.05% or 0.48%, be conscious of what you're paying and what you're getting for it. Every dollar you pay in fees is a dollar that can't compound for you. Let me talk about dividend reinvestment, because this is critical for building wealth. When you receive a dividend, you have two choices. You can take it as cash and spend it, or you can reinvest it to buy more shares. If you're still in accumulation mode, still building your portfolio, you should reinvest every dividend. Don't take the cash. Let it compound. Most brokers offer dividend reinvestment plans, or DRIPs, that automatically reinvest your dividends with no commission. You don't even have to think about it. The dividend hits your account and immediately buys more shares, including fractional shares. Over time, this snowballs. You own more shares, which generate more dividends, which buy more shares. It's the compounding machine. Once you retire and need income, then you switch to taking dividends as cash. But until then, reinvest everything. The difference over 20 or 30 years is staggering. A portfolio that pays $50,000 a year in dividends today could be paying $200,000 or more in 20 years if you reinvest and let it compound. That's how you build real wealth. Here's another strategy I use. I don't just buy dividend stocks and hold forever. I actively manage the portfolio. If a company cuts its dividend, I sell immediately. No questions asked. A dividend cut is a red flag that the business is in trouble. Management is admitting they can't afford to pay shareholders. That's not a company I want to own. Similarly, if a company's fundamentals deteriorate, if their competitive position weakens, if they're losing market share, I'll sell even if they haven't cut the dividend yet. I'm not sentimental about stocks. They're tools for building wealth. If a tool stops working, I replace it. On the flip side, I'm always looking for new opportunities. When high-quality dividend stocks get beaten down during market sell-offs, I'm buying. During the pandemic crash in March of 2020, stocks fell 30% in a few weeks. Quality dividend payers were on sale. I was adding positions. When everyone else was panicking, I was buying assets at a discount. This is the advantage of having cash on the sidelines. When markets crash, and they will crash periodically, you have dry powder to deploy. You can buy great companies at great prices. Then you hold them for years collecting dividends while the stock price recovers. That's how you make outsized returns. Let me address one final criticism of dividend investing. Some people say dividends don't matter because you can create your own dividends by selling shares. If you own a stock that doesn't pay dividends but goes up 10% a year, you can sell 3 or 4% of your shares annually to generate income. Same result, right? Wrong. First, selling shares forces you to realize capital gains and pay taxes. With dividends, you're only taxed on the dividend, not on the underlying shares. Second, selling shares during a downturn locks in losses. If your stock is down 30% and you need cash, you're selling at the worst possible time. With dividends, the company sends you cash regardless of the stock price. You never have to sell at a loss. Third, selling shares means you own fewer shares going forward. Your position shrinks over time. With dividends, you keep all your shares. Your position stays intact or grows if you reinvest. Fourth, many growth stocks don't actually grow 10% a year. They're volatile. Some years up 50%, some years down 30%. If you're selling 4% a year during the down years, you're destroying your portfolio. Dividends are reliable, predictable, sustainable. Selling shares is none of those things. That's why I'll always prefer dividends over manufactured income from share sales. So here's the bottom line. Dividend stocks are the foundation of every serious long-term portfolio. They provide income, stability, and compounding growth. They outperform over long time periods because 71% of total returns come from dividends. They protect you during market crashes by continuing to pay when stock prices fall. They're tax efficient. They force management discipline, and they let you participate in the profits of the best businesses in the world. If you're building a portfolio from scratch, start with dividend aristocrats, companies that have raised their dividends for 25 or more consecutive years. Build a diversified portfolio of 20 to 25 stocks across different sectors. Reinvest every dividend until you need the income. Monitor the companies quarterly to make sure fundamentals remain strong, and be patient. Let time and compounding do the work. If you don't want to pick individual stocks, use a low-cost dividend ETF. You'll get instant diversification and professional management for a small fee. Either way works. The key is committing to the strategy and sticking with it through market cycles. Dividend investing isn't exciting. It's not going to make you rich overnight. You're not going to brag about it at parties. But it works. It's boring, reliable, and wealth building. And boring is exactly what you want when it comes to your financial future.